All right, guys, welcome into today's video. We're here to talk about metamaterials. We're here to talk about MMTLP, and we're here to talk about the CPI data release numbers tomorrow. And we're going to watch a video on that and cover some of the headlines. So a lot of information in today's video, and all I ask in return is smash thumbs up and leave a comment down below, and let's get to it. All right, so yes, MMAT metamaterials had a crappy day in the market. We were down 8.77%. Go here, take a look on the Yahoo Finance. You can see here it was down to 8.77%. We did gain a little bit back after hours. We ended at $1.58. And currently looking here at the futures for tomorrow, S&P futures is up 1.75 points. The Dow futures are up 6 points. And the NASDAQ futures are up 10 points. And the Russell is up a little less than 1%, 1 point. So kind of, I don't know where it's going to go, man. It dropped huge today, and they're all kind of laying flat right now. So we're going to see where the futures lead us to tomorrow. If we go take a look at Metamaterials Volume today, we had average volume is 4.4 million traded, and we traded 3.3 million. So we were about 1.1 million short on the volume. MMTLP is actually down 3.23% today. We are at $1.20, which is fantastic. I'm looking to scoop up a handful of shares again tomorrow if it stays this $1.20, because I'm just happy to keep adding to my position, you know, once or twice a week. Just throw in what I can. That's all we can do, is just keep averaging in. And if you watch my video where I buy MMTLP, it's on TradeStation. And I just want to say, I don't have no affiliate link, guys. I'm not getting any kind of kickback or whatever from TradeStation. I'm not giving you a promo code to use TradeStation or anything. I just want to let you know where I buy that at. Now, Webull, I do have a promo code. If you want to use Webull, you can check out that one down below. So here you can see volume on MMTLP is 396,000 shares, and we traded 287,000 shares. So about 110,000 shares less. All right, so going over here quick to the Fintel, you can see the days to cover went down about 2 days. We are now setting at 15.88 days to cover, which is about 3 weeks. So what that means is, if the shorts had to cover all of their shorted positions, it's going to take them 15 days to do so. Go down here and take a look at the short squeeze scores of 74.84, ranked 911 out of 5,300 stocks. And we did give the update on this yesterday of this whole new update since June 8th. So watch last night's video if you wanted to get the details of why this changed. Now, we have an interesting part here where the short shares that are available jump back up here. Someone put back in. So now we have 850,000 shares, which is more than it's been in a long while. I'm actually shocked that someone returned that many shares. So we'll see if they get scooped back up tomorrow. So we'll keep an eye on that. Going down here, the short bar fee did come down a little bit. We were at the 47% for a couple of days. It did get up to 54, and now we're at a 39.79. So right around 40%. But look at this here, the shorts did not take it easy on us, guys. In the FINRA, we had over 1.5 million shares in the dark pools traded, and they shorted over 71.87% in the FINRA. So that's huge. 71%, are you kidding me? We haven't had in the 70s in a while. We had a couple 60s, but on this chart here, you can see we haven't had anything in the 70s. So they definitely shorted us down today, and that's why you see the stock down 8.77%. All right, moving over here to the Twitter. Got to thank our man Doug C here on Twitter. He says here, don't loan your shares out. Schwab is now paying 18.5%. So thank you to Doug for sharing this. And like I said, I'm not out here endorsing anyone or endorsing Schwab for people to do this. That's your decision. If you choose to lend out your shares, keep in mind, you're helping the shorts, you're helping the hedge funds, you're helping all the people working against the stock. And then doing so, they're going to pay you 18.5% because they need our shares. They need them. And it's a hard to borrow stock. So that's why they're willing to pay 18.5%. And if we get out here and look at Doug's post from yesterday, they were just offering 18% yesterday. So they upped it 0.5%. So as you see here, I think the first video we did was 17%, 17.5%. And now we're up to 18.5%. Schwab is just going to keep increasing because those shorts need our shares. And that's why you got a brokerage like Schwab posting this out here to people to lend out their shares. So thank you again to Doug for sharing that. All right, guys, the big news, why the market sold off. That's right. You go pull up the heat map. and pretty much everything was red today. I mean, portfolios were all down across the board, let's just say, unless if you're in oil and gas stocks, which, hey, even our oil and gas stock MMTLP was down, but whatever. Here you can see this is the big thing leading into tomorrow, and we're going to watch a video as we get into that. Consumer price inflation in May expected to run sizzling hot as energy and food rent rose. So here you can see the economists surveyed by Dow Jones expect the consumer price index was up 8.3% year over year in May, the same as April, while the core inflation is expected to have cooled slightly. High energy prices are driving the headline and continue to ignite the debate about whether inflation has peaked. Markets will focus on whether it appears prices have hit a top and what it means for the Federal Reserve's plans to raise interest rates. So that's what we're kind of waiting on here, guys, is the Fed. If the Fed, once the Fed does the U-turn on this and they say they're not going to raise rates and they get more dovish, the markets will rally. So we're just waiting it out. And all we can do is just buy the dip and hold what we got. Just keep accumulating. If you invest $50 a week, $100 a week, whatever you can afford, even if it's $10, $20 a week or once a month, that's all you can do, guys. Averaging into the market will net you a profit in the long run. All right, so let's go take a look at this interview here, and it's pretty fascinating. I'm going to deactivate the camera, and we're going to go check out this 5-minute video about the CPI report for tomorrow.
Stifel Chief Economist Lindsay Pieggs. Lindsay, it's great to have you back. You know, I was looking at sort of the street's estimates for headline tomorrow, and it's remarkable how concentrated they are in that 8 and, say, 2/10, 3/10 range. What's yours?
We're right in that mix as well. We're looking for 8.2%, which would be down slightly from 8.3, but still a very elevated number. And if we do look at the core measure, as much as it tells us, excluding food and energy, we're looking for the headline to come in just shy of 6%, coming down from 6.2 the month prior. So yes, we are seeing some indications of cooling, but the market is very anxious to call a peak in inflation. And I think that's a bit premature at this point, as we're still seeing conflict overseas, we're still seeing supply chain disruptions, and the Fed hasn't quite choked off the demand side yet.
Right. You know, it's been a couple of weeks where we've seen a lot of signs of disinflation in apparel. We've talked about it in metals, in fertilizer, maybe in chips, maybe in shipping rates. But there's a lot of discussion going into tomorrow about how those things aren't going to move the needle of the index itself, given what's happened to shelter and energy.
Oh, absolutely. So we are seeing some pockets of improvement, that second derivative decline or a slower pace of price appreciation, but we really don't think it's going to be a sizable or meaningful impact on that headline number. And by extension, it's not going to have a meaningful impact for the Fed. The Fed has been very clear that they want to see a very steep downward trajectory in inflation before they're convinced that it's time to pause or slow the pace of policy removal. So tomorrow's number, even with that improvement from 8.3 to 8.2 as we're projecting, that's not going to move the needle for the Fed.
So, Lindsay, it's Steve Grasso. So when you look at the CPI, it's a lagging indicator, number one. So how much information are we really getting there? And number two, can you call a bottom in the market for equity players, not you, for equity players? Can they call a bottom in the market until we've seen, up until we've seen the effects of QT on the tightening process?
So your point to the backward-looking nature of the numbers is absolutely correct. In fact, much of the cooling that we saw last month and are likely to continue to see this month may in fact be a reflection of the improvement in the global economy at the start of the year, before Russia invaded Ukraine, before we saw this second, third, and fourth round of lockdowns overseas. And so again, I do think it's premature that the market is calling a peak in inflation or looking to call for a peak inflation, as it's likely that prices will remain very elevated at this level for quite some time, continuing to put downward pressure on consumers and add uncertainty to the marketplace.
Finally, Lindsay, are you seeing, I mean, one thing that struck me this week is even with oil at 120 and gas a national average of 5, gasoline demand is just getting started, it appears, for the summer. And I wonder, what's the risk of CPI in the summer months actually taking a meaningful leg higher from where we are right now?
Absolutely, and particularly if demand remains elevated for energy. Because right now, consumers are still out in the marketplace spending, but obviously higher prices is cutting into the amount that we're taking home. But if consumers are more interested in going on that vacation, driving somewhere this summer, and foregoing purchases elsewhere, what we see is simply a shift in allocation of capital towards that energy component. So not only are prices on the rise, but demand could stay steady or even increase, as we typically see in the summer, at the detriment of other categories, perpetuating, though, that rise in the energy sector in terms of prices.
We'll see what we get in the morning. Lindsay, as always, thanks so much. Good to see you.
Thank you.
Joining us from Stifel today. Bonawyn, does it make you think maybe the table is set for more than 50, maybe 75, maybe a point, maybe an intermediate hike?
Maybe if they hadn't taken 75 off the table. And there was much ado made about why would you remove that from your quiver? You may need that arrow. And I'm with her. And I'll take it a step further. I think peak inflation is a misnomer. It doesn't matter. It doesn't matter. I'll tell you what we have. We have persistently elevated, unactionable inflation, and it's volatile. So the things that we're saying we're getting some puts in now. Okay, so food's a little bit cheaper. Lumber prices, we've gotten some abatement there. But now energy, commodity prices are now much higher. So the Fed is going to need to see a sustained downward trajectory and really be able to wrap their hands around exactly where this is trending towards before they're going to move. I think we're just really trying to reverse and engineer the narrative that we want to hear and make a case for why we want to buy the market. And I just simply think that the rules of engagement have changed. Yeah, the Fed is in a different position.
Yeah, it's a rolling series of non-synchronized events, war, China, inflation, you name it. That's going to make it hard to time.
All right, let me get the camera back here. All right, so there it is, guys. That is what I got for you in today's video. I hope you all enjoyed. I think that interview was a definitely must watch. And I think until we see the Fed U-turn and go dovish, and from the sounds of that there, that's not going to happen until the Fed sees the CPI numbers coming down drastically. This tenth of a point that it may be down tomorrow is not going to change the Fed's mind. So we got to be strong. We got to be mentally tough. We got to know what we hold, and we got to be prepared for the worst. So we don't know what can happen, man. Just look at a couple stocks today. Look at DocuSign today. Wow. DocuSign was down over 25% or so after hours on earnings. Stitch Fix was down like 24% or something like that. It's crazy. So just be prepared for the worst, because if this number comes in, the market could do what it wants. So hope you all enjoyed today's video. If you did, smash thumbs up, leave me a comment down below, and I will catch you all next video, guys. Peace.